What exactly does a central bank do? And why does it seem like they control so much of the economy? Let's break down the role of central banks and how they manage things like inflation, interest rates, and economic stability. A central bank is the institution responsible for overseeing a country's monetary system and managing its currency. Some of the most well-known central banks are the Federal Reserve in the United States, the Reserve Bank of New Zealand, and the European Central Bank. These banks aren't like commercial banks that deal directly with the public. Instead, they work with the government and financial institutions to maintain economic stability. The central bank's primary role is to manage a country's money supply, inflation, and interest rates. They have a lot of power to influence the economy by controlling how much money circulates and the cost of borrowing that money. This is crucial because too much money can lead to inflation, where prices rise too quickly, and too little money can lead to stagnation or even recession, where the economy slows down. One of the central bank's key jobs is controlling inflation, which happens when prices of goods and services rise, eroding the value of money. When inflation rises too high, the central bank typically increases interest rates. This discourages borrowing and encourages saving, cooling down spending in the economy. Conversely, when inflation is low or the economy is slowing, the central bank can cut interest rates, making borrowing cheaper and encouraging people and businesses to spend more. This stimulates the economy. Interest rates are a major tool that central banks use. When they increase interest rates, it becomes more expensive for people and businesses to borrow money. Mortgages, loans, and credit card rates go up. This discourages spending and investing, which can help slow inflation. On the other hand, if they lower rates, borrowing becomes cheaper, which stimulates spending and investment. So, raising and lowering interest rates is one of the central bank's most powerful tools. Central banks are usually designed to operate independently of direct government control, but they still have close connections to government policies. Their independence is crucial for making unbiased decisions about the economy, especially when it comes to controlling inflation and interest rates. However, they often coordinate with the government to ensure fiscal policy, government spending and taxes, and monetary policy, money supply and interest rates work in harmony. For example, if a government is overspending, it can lead to inflation, and the central bank may have to intervene by adjusting interest rates to maintain balance. A good example of central bank intervention is during the 2008 global financial crisis. Many central banks, including the US Federal Reserve, slashed interest rates to near zero and injected huge amounts of money into the economy to stabilize the financial system. Without these actions, the recession could have been much worse. However, central banks aren't perfect, and there have been cases where mismanagement has hurt economies. For instance, in Zimbabwe, hyperinflation occurred partly because the central bank printed excessive amounts of money, leading to the currency's collapse. Central banks do hold significant power, but they don't operate in a vacuum. Their decisions are based on a range of economic data, including inflation rates, employment levels, and GDP growth. These data points inform their policies. The ultimate goal of a central bank is to create a stable environment for long-term economic growth. While it might seem like they can just increase or decrease interest rates, they are guided by complex analyses and models to achieve the best outcome for the economy. In some cases, central banks make decisions that can lead to negative outcomes, especially if the underlying economic data is misinterpreted. However, more often than not, their role is to correct imbalances. If a central bank fails to control inflation or doesn't act quickly enough, it can lead to a crisis. While Venezuela's collapse was more due to government mismanagement than central bank decisions, it's a reminder of the delicate balance central banks must maintain. So, the next time you hear about interest rates going up or down, you'll know it's the central bank working behind the scenes to keep the economy balanced. Their role is crucial in maintaining financial stability, and while they do have a lot of power, their decisions are rooted in protecting the economy as a whole.